we did see rotations into discretionary. That was the one big move today.
That was the excitement, right?
Yeah.
And I think it was Norwegian Cruise that had a good report that kind of got people excited again about discretionary. But it has been all about rotation all year long, and today was no different. It was oil fell, a couple of good earnings reports in discretionary, so discretionary be outperformed and staples lagged, and that has actually been the reverse over the last month, where staples, more defensive trades have been kind of outperforming. So it's sort of interesting in itself, but you're right, it was sort of a quiet day.
Well, Amazon up 12 bucks, which is, you know,
I'll take it.
2/3%. Sure. First time over 1,900, or just intraday anyway.
That's interesting.
And it's consumer discretionary, so it goes up just because.
Yeah, but you know, department stores were also up today.
Oh, no,
and
the whole sector was good.
It really was across the board.
And Mike, 8th positive session in a row for the NASDAQ. Only slightly positive, but that's the longest winning streak for 2018, which is kind of astonishing given that not much is happening in the last week.
It's giving kind of new definition to slow and steady, because increments every day are not very large. But it's sort of like last year a little bit, right? Really low volatility, kind of a gentle rotation in the markets, and then by default, big tech goes up a little bit every day.
John Augustine, what are you doing here? You long, you short, you like this market?
Long, like the market, think the fundamentals are there. We did see the drift today, as you all were talking about. We've seen the sector rotation, but what caught our eye today, small caps. Small caps are still up. We still favor them. They're still working for our customers.
The S&P 500 is inching towards its first record close since January, the level to watch, 2873. Right now, the S&P is less than 20 points away from that. Now, despite that, stock valuations are slipping. The S&P 500 trades at less than 19 times earnings. This is low compared to the indice's peak in January, when the S&P traded at nearly 22 times earnings. Mike, those are, of course, current year earnings. Forward-looking is a little...
No, actually, that's trailing earnings.
That's trailing earnings.
Yeah.
Forward-looking earnings, it's a little bit more attractive still, of course.
Forward-looking earnings right now for the S&P is about 16.5 times, a little bit more than that, and it was about 18.5 times in January. So earnings up 20% in half a year, that's going to do that when you have essentially a flat market. Though the forward multiple right now is right about the 3-year average, right about the 5-year average. So it's not as if it's in a vacuum cheap. It's just radically cheaper than it was a little while ago. And, you know, bond yields just being sideways here, it seems like the relative value is okay for stocks at the moment.
John, what's your take on valuations at the moment?
Nah, same. As Mike talked about, 18.5 forward PE beginning of the year, 16.5 now. We go back all the way to 1995, and it's about 16 times to 1995. So that makes us constructive on this market. We're long the market. We're overweight to equities, and we're following the rotation that Stephanie talked about. It can get frustrating, but if you're diversified, customers are doing okay and investors are doing okay this year.